Hey, this is Ken at Capital Advantage Shooting, and it's my job to get you past the Series 66, and that's really what we're here to do. Get out of here. Okay, so we are trying to get you past the 66 exam, and we're going to help you out with brutal exam number 2. It might be a 2A and 2B. I'll make one big one at some point, but I want to get this out there for some of my friends who are taking the test very soon. So this is an exam that is going to give you the same vibe as the real exam. It's not questions from the exam, but it's going to give you the same feel for the real exam. So I call Brutal 2, and I don't know, I think the second half I may have Grok or Perplexity take it with me because it takes longer to do that, but let's see what happens. Let's get into it.
If this speech stirs your heart, show your allegiance, like the video, subscribe to the cause, and together we shall conquer the future.
Let's start with number 1, baby. Let's see how we do. Let me show I'm loud enough. I think I am loud enough for you guys. Okay. Under the USA, in order to issue securities in a state, the securities must be what? A, registered, exempt, or federally covered. B, registered. C, exempt. D, federally covered. So this is one of those where you have to pick the best answer because technically B, C, and D are all correct. Now remember, guys, what we're going to do is you bring the question up, slap pause on that, answer yourself, see how I answer it, and then if you disagree with me, because remember, these are questions I kind of made up, so I don't really know the answer. I know the answer, but I know most of them, and I could be wrong. I could have a bad take. If you do my other brutal exams, you can see I make mistakes. So your job is to find the mistakes and comment them and call me an idiot. Okay. So again, back to this. Under the USA, in order to issue securities in a state, the securities must be, I'm going to go with A, registered, exempt, or federally covered. So remember, always when you have securities, you're going to sell them, they have to be one of 3 things. Either registered, one of these has to be a yes. Registered, qualification and coordination. Exempt, which is that whole list, or an exempt transaction. Or federally covered, which is exempt. One of those has to be a yes. So the answer is A, is an apple. Under the USA, again, common theme. Registration by qualification. That's one state becomes effective when? Pause. Okay. 30 days, when the administrator orders. 2 days offering prices, or when the federal registration becomes effective. So qualification is one state only. You are effective when the administrator says you are. So B as in boy. Okay. Which of the following is an advantage of operating as a sole proprietorship? A, ease of transferring ownership. B, ease of formation. C, limited liability for the owner. D, double taxation of income. So let's see, C Corp, that wouldn't be an advantage. That C Corp's a double taxation. You don't have a limited liability. You can't really transfer ownership that well because you're alone. Remember a sole prop? So I'm going to go with ease of formation. It's literally as easy as saying, hey, I'm a sole prop. Start taxing me that way. And you're taxed as an individual. It's on your 1040. Good. Okay. If an investment advisor uses a solicitor to refer clients, the advisor must maintain which of the following records? D, copies of the solicitor form U4. C, financial statements of the solicitor. B, background investigation of the solicitor. Or proof of delivery of the solicitor's disclosure doc to the client. So remember, disclosure doc is also known as ADV Bardos or the brochure. So the answer here is A as an apple. They don't have to sign it, but you have to have some sort of proof of delivery to know that they gave it to them at or prior to signing the contract. Wunderbar, A as an apple. After an IPO of a special SPAC, okay, after a SPAC IPO, the proceeds must be held in, I've been seeing some version of this on the exam. It's either in a trust, a money market, a custodial account, or prime brokerage. Now, we know it's not a custodial account. I mean, I guess it could be, but we're going to not go there. It's not a money market. It's going to be in a trust. Always remember, the money for a SPAC is held in a trust. And what's a SPAC? That's like it's like almost like a blind, it's almost like a blank check company, but it's a blind pool in a way, because what you do is say, I go, oh, I want to raise money. I don't know what I'm going to do, but I'm going to find a company to bring public in the next 2 years. But we don't know what company it is yet. So you're going to give me the money, and over the next 2 years, I'm going to try to find a company to bring public. Do a reverse merger, bring it public, all that stuff. And after the 2 years, if I don't find one, I give you your money back. So the money has to be held in a trust, so it's a little safe. Now, you may be earning a little bit of money. It may be invested in money markets, but it's not held in money markets. So the answer is A. What is the debt to equity ratio of a corporation? A, the market value of the debt compared to the market value of the equity. B, the amount of capital a company raised by borrowing as a company as compared to selling ownership. C, the amount of current assets compared to the current liabilities. And D, the price of the equity compared to the price of the debt. So debt to equity is how much debt we have versus equity. So I'm going to say it's not C, okay? It's not C, it's not D, it's not A. Because it's not the market value, it's the amount. So I'm going to go with B as in boy on this one. If you disagree, let me know. I'm sure you will. People like to do that. So the answer is B. And then I'll prove you damn wrong. Okay. Under the USA, I wonder why they keep bringing that up. Which of the following statements regarding post-registration requirements for an IA with their principal place of business in a state is correct? A, file financial reports with the state. B, required to update the form with the state if it becomes materially inaccurate. C, shall schedule an annual examination with the administrator. D, to maintain records. Okay. So here's the thing. What's the best? The question is, what's the wrong answer? Because if you miss the word incorrect, you start thinking, oh, look, here's what I did. I read this and go, wait a second, A is right, and B is right. Once I see more than one right, I go back and check to see if it says incorrect or accept or something like that. So here, remember that it's not true. We do maintain records, we do require to update the form, and we do financial reports. We don't schedule an examination with the administrator. We will have, if we have custody, we will have an auditor come in with a surprise audit, or we will have an auditor come in to audit our books. We will schedule that. But the administrator comes in whenever they want. Keep that in mind. That may show up later. Under the Uniform Securities Act, otherwise known as the USA, if the information contained in Form ADV becomes inaccurate or incomplete in any material respect, an investment advisor is required to file a correcting amendment with the state securities administrator, A, within 24 hours, B, within the next 45 days, C, promptly, D, at the next annual filing. I'm going to go with, I want to say 24 hours, but I'm not. I'm going to say promptly. So any kind of material change has to be done promptly. What's promptly? Whatever the hell they say it is. So promptly is the answer. Okay, here we go. The issuer of which of the following securities must file advertisements with the state administrator? Corporate debentures, B, Canadian government securities, C, state issued, D, U.S. savings bonds. Well, D is not a security, so it's not a thing. D, state issued bonds or munis, just worded weirdly. B, Canadian is exempt. The answer is corporate debentures. Remember, debenture, anything, pretty much, if you hear the word non-exempt, it means corporate pretty much. So corporate debentures are unsecured bonds, okay? Will be unsecured bonds that are done by a corporation. Okay? Okay, here we go. Let's do this one. Oh, a little mathy math. What a pain. Okay, here we go. So let's read it together. You guys try to do it before I do. What's the FV of a 3-year investment if the rate of return is 5% and $0 be invested in year 1, 2 in year 2, and 1,000 in year 3? So let's do it. Let's do this. Okay, so first year, nothing. So we don't do anything. So I'm going to leave that out. Now let's make it a little smaller. That's what she said. Never to me. The other way around. Make it bigger, baby. Okay, so now, so we go. The first year we have $2,000. Then we have to multiply that. How to get present value? You're going to multiply times 1.05. So we do $2,000. Get the old candy dandy calculator out. $2,000 times 1.05 equals 2,100. Now remember, we added another thing as we go through 2,100 plus 1,000 because we added 1,000 equals 3,100 times 1.05. So 3,100, you'll probably get what it is because it has to be 3,100 times 1.05 is 3,255. Boom. Now, in reality, you could have made your life easier, right? Because look, even if you go, I can't do the math, you know it's not A or B, A or C, because they're below $3,000. And how much did you put in? $2,000 and 1,000. You know that's $3,000. Since you know you're owing money, it has to be more than $3,000 anyway. So the answer has to be B. Even if you couldn't do the math, but we did it because we really are smart. Okay. To comply with Section 404 of the Safe Harbor provisions for qualified retirement plans, all of the following statements must be true about the plan except A, the plan must offer at least 3 diversified categories of investments with material different risks. B, the plan Participants must be permitted to make changes at least quarterly. C, the employer must offer its own stock as one of the investment options. D, the sponsor must offer appropriate investor education about the importance of diversification, the relationship, blah, blah, blah. So 404, what do we not? It's the next sub question. What do we not have to do? So we're not going to offer our own stock. That's not a requirement. That doesn't help us. If we want to not be sued, we have to give at least 3 diversifications. They have to be changed quarterly, and we have to have education to teach them about this shit. So the answer is C, as in catatonic. Hey, sorry to pop in here, but STC Securities Training Corp, I'll put the link up here if I can, has some great questions. You can buy supplemental exams. They have all questions that sort of like this. They give the same vibe as a test. Let's go, baby. Okay. Which of the following is an investment advisor representative? A, supervisor of IARs. B, professor who teaches comprehensive financial planning. C, a person with more than 50% ownership in an advisor. D, a publisher of a bona fide securities newsletter. Okay, so let's knock out the publisher. Boom. I'm going to throw that shit out. Knock the publisher out. Don't hit him too hard. Now, teacher, that's one of the plate things. Publisher, lawyer, accountant, teacher, engineer. And supervisor, investment advisor, reps, C person. Okay. I'm leaning toward, I don't want to do C because just because you're an owner doesn't mean that you are on the whole thing. You're not supervising. So the definition of an IAR is someone who gives advice or supervising those that do. So the answer is A, as an awesome sauce. Good. Okay. Which investment is never suitable for an individual retirement account? A, muni. B, common. C, call. D, mutual fund. The answer is, we all know this one, muni bonds. This is easy. You don't put muni bonds in an IRA. Since you're already tax-free, that means they have a low coupon. Why give up the coupon when you have a tax-free account or tax-deferred account? The answer is A. Okay, next. Guys, don't forget, I'm going to try to put a little surprise at the end of this, not a link like the last one. I want to put a little surprise where you get a little feedback, almost like a little quick and dirty at the end of the video. If I finish this in part one, in wall one thing, then it'll be into this one. If I don't, then it'll be into part 2. Okay, which then I'll combine at some point. Which of the following best hedges a long stock position? So remember, if I'm long stock, remember past pause before I start rambling. If I'm long stock, it's bullish. You have to do various things. I either sell a call for income or I buy a put for protection. Those are the only 2 choices. So I want to protect, buy a put A. So remember, from long stock, you either sell a call or buy a put. No other choices. Boom, boom, boom. Okay. Another present value. Oh, they're killing me here. Okay. Present value of fixed income. So that's the present value is kind of like, how do we get present value? We use DCF, discounted cash flow. That means taking all the future cash flows and discounting them. Oh, I think we got our answer. So it's not the sum of all expected payments. It's not the price to pay, because that's the market price. I mean, that's what you want to pay, right? Or a little lower than present value. Par is just not a thing. So it's sum of all discounted cash flows, right? So we're discounting all the future cash flows to find the present value. So that's C as in Charlie. Good. Okay. You guys are my guinea pigs, so I'm editing as we go. Which of the following is required to be registered as an IA under the USA? A publisher that charges her a subscription to personal securities advice. B, a BD whose advice is incidental. C, an individual who publishes reports not based on specific securities. And D, a person whose investment advice is based on government securities. So now I'm torn on this, right? So here's the deal. Technically, I'm between A and D. I like A a lot better. I could see the D, but remember, no one needs the D. So the whole point here is that, remember, if you're only based on government securities, then you miss that part. So I'm going to go with A because you charge for subscription for personal securities advice. There we go. I'm going to double check here just to make sure I don't look like an idiot. We're good to go. Onward. Oh, it's a long one. Jeez. Okay. An investment advisor employs one investment advisor rep who acts as a sole prop. The investment advisor representative maintains all the IA's client files and other books and research on a cloud-based server, for which the investment advisor pays a monthly fee. The investment advisor has decided to transition to a free, if it's free, it's for me, cloud-based service and engage in due diligence prior to selecting the free cloud-based service. Has the investment advisor compiled all the applicable models and guidance? Okay. A, no, because a free cloud-based server cannot be approved. That's not true. The SEC doesn't approve anything. Remember that. No regulator ever approves anything ever. B, no, because fee-based service is more likely to have service disruptions. No. That makes sense. C, yes, if the investment advisor's due diligence focus on the protection, backup, and recovery books and records. Should change that to right? I'm sure. And books and records. D, yes, if the investment advisor deletes all of the copies of the books and records once transitioned to the free cloud service. That's fucking nuts. So the answer is C, is in Charlie. Yeah, as long as you meet the rules, we're fine. Okay. So then again, C is in Charlie. Upon the death, oh my lord, upon the death of a client, a registered rep may accept instructions from which of the following? A person holding a durable power of attorney. B, a client's adult son who's a beneficiary. C, the executor of the client's estate. D, the client's spouse if named as a beneficiary. So your client died, dead as a doornail. Who can you get stuff from? Durable doesn't work because it ends at death. Adult son, beneficiaries don't matter unless you get the will and they told you to use them. So the executor of the estate. So until it's cleared up and you know who the money goes to, the only one you can take instruction from is the executor. Or the court, anyway. Okay. An investment advisor represent IAR handling an IRA may execute in an order when A, the client receives a tip from a friend. Ooh. B, a client's attorney provides verbal instructions. C, the client's adult son beneficiary provides instructions. He's not fucking dead yet, and it wouldn't matter anyway. And D, none of the above. Okay, so the answer here, my friend, is a tip from a friend. Even though I always think tip as insider trading, it doesn't say. So you can execute orders if your friend says, hey, if your client's friend says, hey, you should buy this, you can execute the order. It's not a problem. The verbal instruction thing can knock you off a little bit, but don't remember, it's not the lawyer who can get verbal. It's the IAR who can get verbal for up to 10 days. 10 days of oral, baby. Now, a company has a PE ratio of 12. Just in case I didn't say it, the answer is A as an apple. A company has a PE ratio of 12. Pays a 3.5% dividend and sets aside $12 million in reserves for a rainy day. This company is best described as A small cap, B growth stock, C value, D micro cap. Okay. Well, it's not small growth or micro cap because that does nothing to it. So it's a value stock. Growth is a high PE, like 30, no dividend, no money saved. They're just ballers reinvesting. So everything here screams value. Low PE, they pay a dividend, and they set aside money for a rainy day. I'd say it's a value company. Because remember, value companies are not shitty companies. They're just big established companies that are kind of out of favor. A trustee is prohibited. So again, C is in Charlie. A trustee is prohibited from delegating which of the following? A, portfolio management decisions. B, authority to hire money managers. D, discretion over trade execution. And C is the answer. Authority over distributions and payments to beneficiaries. So the trustee can look, if I name somebody who's brand new in the business, but I trust them to be the trustee of the account, well, maybe he can't pick stocks yet, or she can't pick stocks, so they can hire someone else to do it. But as far as distributions and payouts to the beneficiaries, that has to go with the trustee. Can't send that. I can't third party that shit out. Okay, let me clean this up a little bit. Let's make it. Okay, there we go. Okay. Two close friends work in unaffiliated broker-dealers. The more successful friend offers to send some clients to the other who's struggling to open an account. The friends agree to share the commission. Which of the following statements about this treatment is true? This is not permitted because the friends work for unaffiliated broker-dealers. This is permitted since the two agents have a personal relationship. This is permitted if both of the broker-dealers agree to the sharing of commissions. D, this is permitted if their friends are both registered agents of the broker-dealers in the same state. So the answer is A, okay? So the answer is A because unaffiliated broker-dealers cannot share commissions. However, if they are affiliated broker-dealers, then it would probably be somewhat closer to D. They have to be similarly registered where the customer is located. So the answer is A because they're unaffiliated. If they were affiliated, then D would probably be the closest answer. Okay. Which of the following provision is not permitted in an investment advisory contract? A fee based on the average value of the account at the end of the quarter. B, a fee based on the difference in the value of the account at the end of the quarter. C, a fee based on the average value of the account at the end of the quarter. D, a fee based on the average value of the account at the end of the quarter. C, a fixed fee of a develop a financial plan. D, charging a fixed hourly rate for any time spent advising the account. Do 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 do. Boom. Can't do performance-based fees, baby. So the answer is B, as in boy, boing. So it's B. Okay. Because now, if they're qualified, you can do that. It doesn't say qualified, so you assume you don't assume qualification if they're not. So the answer is B, as in boing. Okay. If an investment advisor sends account statements directly to clients instead of having the qualified custodian do it, that's what I read into it. This indicates, okay, A, the advisor is not out of custody. B, the advisor has custody. C, custody depends on whether fees are deducted. D, this is prohibited. Nope, the answer is B, as in boing. So remember, there's a couple of things that trigger custody. If you're named as a trustee on the account, if you send statements to the customer versus the custodian, if you get money, if you get prepaid fees of 500 or 1200, 500 state, 1200 federal, 6 months ahead of giving advice, that's custody. If you get money and don't forward or return it within 3 days, that's custody. If you have full discretion, that's custody. So, but one of them is sending statements to the client directly, because then you're holding, the idea is that you're holding their account. The answer is, again, B as in boy. A 62-year-old woman withdraws funds from her qualified annuity. The withdrawal is taxed as A, capital gains plus penalty, B, capital gains without penalty, C, ordinary income plus penalty, D, ordinary income without penalty. So the answer is D, as in David, ordinary income without penalty, because she's old enough, she's over 59 and a half, and it's ordinary income because capital gains, remember, there's only three things that are capital gains: a buy and a sell, option expiration, and when a mutual fund distributes actual capital gains. Other than that, it's ordinary income. So, and again, all retirement shit is always ordinary income. They call it gains, but it's really ordinary income. Oh, according to the Investment Company Act of 1940, which of the following is an investment company? A, individual manages securities portfolios. B, a company with 80 shareholders that has received less than 500 grand of contributions. C, a company that primarily holds itself out as a business of investing in securities. D, a company whose only investors are qualified purchasers. I go with C as in Charlie. If you're a company that primarily holds itself out as a business of investing in securities, I like that. I'm going to double check because I feel I am making a fool of myself. We should be good. Time warp. So the thing here is that the reason B isn't it is because that's more of a private fund than anything else. So the answer is C. It's literally in the act. If you hold this about business of investing, reinvesting, trading, you could be an investment company. The answer is C as in cookie. C is for cookie. Unless an exemption applies, which the following is prohibited fee arrangement for an investment advisor. See if you guys learned anything from a couple questions before. Okay. A, charging a fixed percentage of the account value after the end of a quarter. Charging a fixed percentage of the account value at the end of the quarter, the year. Charging a fixed percentage of the change in the account value at the end of the order. D, charging a fixed dollar amount at the end of the quarter. So A, Apple, Boy, and David are all good. Again, no change in account value because no performance-based fees unless they are qualified customers and they agree to it. An agent of a broker-dealer has been directed to transfer a portion of a customer's 401k plan to a spouse as part of a divorce settlement. Which of the following statements is true regarding this request? A, assets cannot be transferred out of the 401k. B, a qualified QDRO, I'm not reading the whole fucking thing, is required to complete the transfer. An IRS determination letter is required. D, permission from the spouse's employer required. Nope. The answer is a QDRO. So if you get a divorce, always think divorce, QDRO, they kind of go together. Don't confuse it with QDIA, which is for like target-based funds. It's a QDIA is when it shows up is if you have a target-based fund, they automatically allocate your investments based on how long you're gonna until you have to take it out. And or if you decide to have a 401k and don't decide to invest in anything, it would automatically invest for you. Okay. Here we go. What type of business is subject to double taxation? C Corp, A, B, S Corp, C LLC, D partnership. So the answer is C Corp every freaking time. C Corp, C Corp, C Corp. C Corp's a double tax, but they are the best way to get a shitload of money. Good. Here we go. So the answer is A as in Apple. A is C. So it's A. What's a futures contract? A contract to deliver commodity on a set date and price. B, a contract to deliver commodity on a set date at a future market price. C, an option to buy a commodity at a set price. D, an option to sell a commodity. Okay. So D is a call, a futures call, a call on a future. Sorry. C is a call on a future. D is a put on a future. So it's between A and B. Remember, it's not at a future price. It's going to be at a current price. You're promising to deliver it at the price we did it at. So if I buy a 50-cent future, I promise to buy it from you at 50 cents in the future. If you sell me a 50-cent future, you promise to sell it to me at 50 cents in the future. So the answer is A. Good. Which of the following scenarios would require an IAR to register in a state, even if the advisor is federally covered? The IAR conducts one meeting per quarter with a client at a teleconference in that state. The IAR sends email communications to client in that state from the firm's headquarters. C, the IAR attends one-time industry conference in that state. And D, the IAR provides pre-recorded webinar access to residents of that state. So the answer is A as an apple. Now, here's the thing you have to understand. At first, you think, oh, wait, what about C? They're sending out shit, or B, they're sending shit out. Remember, if you work for a state advisor, it's either an office or more than 5 clients, or 6 or more, whatever you want to say. But if you work for a federal covered advisor, it's only if you have a place of business. You could have the entire state of Idaho, all 28 people that live in Idaho, you could have every one of them as a client, but you don't have to register. But if you work for a state guy, you do. A state advisor, you do. So the answer is A, because you work for a federal covered advisor. If you have an office where you meet regularly, that is going to make you register. So the answer is A. And you're going to come at me and say I'm wrong. I am not fucking wrong on this. Okay. Which of the following is true of an income portfolio? It is primarily invested in undervalued stocks. B, primarily seeks capital appreciation. C, is invested exclusively in bonds. D, it is designed to produce reliable dividend and interest payments. So the answer is D, as in David, because A is not true, B is not true, and then C, if it said bonds and other things, I would take it, but it said only bonds, so not. Only bonds, only fans, whatever it is. Only bonds, the new subscription price, where you get to see bonds take their clothes off. Okay. So the answer is D. I go on tangents once in a while. Under the USA, again, under USA, the administrator may inspect the broker-dealer or IA records, A, once every 12 months, B, whenever considered appropriate with their notice, C, only with prior written notice, D, on a quarterly schedule. They can come in whenever they fucking want. So the answer is B, as in boy. Yes, and Kaplan or SDC has a stupid question where the answer is A, whenever they want, and the other choice is only during business hours. That's a stupid question that the test will never do. So it's whenever they want. What must be filed with the IARD for an individual to register as an IAR? So IAR, A, statement of financial condition. No. B, surety bond. Well, if they have custody, yes, but no. A completed Form ADV, that's for an advisor, not a rep. D, consent to serve as a process. I'm going to go with D as in David. D as a consent to serve as a process, because anything that has a register in the state has to do a consent to serve as a process, which is basically allowing the administrator to accept legal papers on your behalf, which makes it easier to sue you. Good. Here we go. A limited partnership realizes capital gains in November and distributes those gains to partners in January of the following year. When are the gains taxable to the partners? A, ordinary income in the year distributed is received. B, capital gains in the year distribution is received. I can't talk. C, ordinary income in the year the gains are realized. And D, capital gains in the year the gains are realized. So here's the deal. With the partnership, you're considered part of the partnership. So you pay taxes on the year that they get it, not that they realize it, not the day you get it. So even if they realize 50 grand and somehow don't distribute it, it's on your tax form. So the answer is D as in David. Okay. Here's a tricky one. A European call option is considered a derivative because A, it can only be exercised at expiration. B, derives its value from the price of another security. C, can only be purchased by investors in Europe. D, it trades only in European exchanges. Okay, so C and D are fucking stupid, so we throw them out. A and B. So a European style call option can only be exercised at expiration. They didn't ask that, though. They asked, why is it a derivative? Because it derives its value from the price of another security. So the answer is B. Even though A is a correct statement, is a true statement, it's not the correct answer. It is true, but not correct. So B. Under the USA, which of the following is considered an agent? A, an employee of a bank selling bank-owned securities. B, a salesperson offering non-exempt securities, non-exempt transaction. C, a partner firm has no involvement in sales. D, an individual representing an issuer and exempt transactions only. So the answer is B as in boy. Because look, A, work for a bank, they're fucking ghosts. C, partner, doesn't matter unless they're supervising. D, representing exempt transactions, they're exempt. As long as you work for the issuer and they're exempt, it matters. If you work for the broker dealer and it's exempt, it doesn't matter. So the answer is B as in boy. Okay. Which of the following provisions applies to joint tenancy by the entirety, but not to joint tenants with rights to survivorship? Okay. Let me clean this up. Okay. Both parties must approve the sale of an asset. Upon death of one owner, the property goes to the survivor. C, equal ownership of the property. D, only one party approval is needed to the property. Okay. So remember, they're not asking what's true. They're asking what's true of one and not the other. So B is for both, probably. C is for both. D is for neither, is for the second one. So the answer is both parties. So remember, tenants and entitled is only for miserable, married people. Anyone who's married can do a tenants in the entirety. And the reason you do it is if you buy property, it's protected from creditors unless both people are named as creditors. So if I do something stupid and get sued, they can't touch the house if it's in tenants by entirety unless my wife is also named. Okay. Which type of retirement account provides employees with ownership in the company? ESOP, 401k, IRA, and 403b. So let's go through it. What does ESOP stand for? Employee stock ownership plan. So it's A. A is an apple, baby. So Ryan / toilet paper, if you're watching this, you just texted me right now. So you texted me asking me about it. So just keep that in mind. When you watch this, you can laugh because this is exactly when you texted me to say, am I going to drop this thing? So hopefully I'm going to do it, you bastard. Okay. An individual paid a commission by a broker-dealer to sell and issue securities. The individual is considered. So an individual is paid by commission by a broker-dealer selling issuer securities. This is A, an agent of the issuer, B, agent of the broker-dealer, C, an agent of both the issuer and the broker-dealer, D, exempt from definition of an agent. I'm going to go with broker-dealer, an agent of a broker-dealer, because he works for the broker-dealer. Because if you work for a broker-dealer trying to sell shares for an issuer, you still work for the broker-dealer. Okay, so the answer is B. Which efficient market hypothesis assumes that all public and private information is available to all investors? A, weak form. B, moderate form. C, semi-strong. D, strong. The answer is D, as in David. Strong form, baby. Strong form believes all public and private information is built in. A, weak just believes how historical that is. Fundamental may work. Okay. No such thing as moderate. Semi-strong believes that all public knowledge is built in, but not not private information. So the answer is D as in David. I have a feeling most of the time it's D as in David, but whatever. Okay. Most of the time it's strong, not D, the letter D, strong. Under the USA of Act 1956, a federal covered advisor who is located in a state must do each of the following. A, comply with state minimum financials. B, comply with state's custody. C, maintain the books and records. D, make a notice filing. I'm going to go with, since it's a federal covered advisor, they don't register because you can't register in both if you're an advisor. So it's not A, B, or C. So it's got to be D because you're federal. You just notice filing the state, letting them know you're there. Good. Okay. Which investment provides returns that are based on both appreciation and investment income? Total return fund, index fund, growth fund, income fund. Okay. So A is total, B is index, C is growth, D is income fund. Which investment provides returns that are based on both appreciation and investment income? I am going to go with a total return fund. That's got to be it. Total return fund, baby. Okay. Because total return is growth plus income divided by original. So that's the answer. An IAR discovers, so again, the answer is A, is an apple. An IAR representative discovers that a client is a company executive who possesses material non-public information about his employer. The client asks for permission to discuss the information with the IAR to help formulate an investment strategy. What should the IAR do? All of you should get this right. A, accept the information and use the information barriers to prevent trading. I love it. No. B, refuse to accept the information and document. C, accept the information and place it in a separately secured file. D, immediately report to the SEC. No. The answer is B as in boy. The answer is B is important. You don't report them to the SEC just because they're talking about it. I mean, yeah, eventually if they trade on it, but you just refuse to accept and document the conversation. Which of the following is considered an IAR? Let me put some space between these two. An agent of a broker-dealer who gives advice when soliciting securities transactions. No. B, a lawyer gives casual investment advice as part of his standard legal services. I don't think so. C, an accountant who gives investment advice for an additional fee. Maybe. D, an officer of a trust company, which is a bank, which is exempt. So it's got to be C. So I'm going to change up the way I do it to make sure we get through all of it and I don't go nuts. I'm going to read the answers and try to filter them out as I go so you can hear me. So make sure you press pause right after I read or right when you see the question pop up, press pause and answer it yourself. Okay. So the answer is C because you're charging an additional fee on top of the accounting. Which of the following is considered a security? A, universal life? No, because it's life insurance. B, whole life? No. C, variable annuity? Maybe. D, universal life with flexible agreements. They try to trick you with the flexible shit, but no. The answer is C as in Charlie, a variable annuity with fixed and variable sub-accounts. Boom, 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 boom. Okay. Yeah, Ryan just answered me. So there we go. An investment advisor rep registers with which of the following? SEC? No. NASA? I'd love to say yes, but no, they just write the rules. C, FINRA? No, that'd be a registered rep. And D, state administrator. So the answer is D, as in David, the state administrator. A federal covered advisor has five, yes, count them, five clients in State B. The advisor may be required to notice file in State B if it signs a contract with which of the following customers. So they're saying which of the following customers would cause them to have to register. Let's clean this up, make it nice and a little more grammatically correct. Which, with, no, we're going to keep which. Okay. A trust company that gives the advisor 100 grand to manage. That sounds like a bank to me. It's an institution. A testamentary trust with $1 million in assets. Maybe. A state-sponsored investment fund? No, that sounds like it's an institution. And B, an investment company sounds like an institution. I will go with B because it's just a trust with $1 million. That's still considered retail. I think a trust has to have $5 million. I'm not sure of the number. So I think that's retail. So if you go with a retail client, you have 5 already, and you add the 6, you are going to have to notice file in the state. Ba-boom, ba-boom, ba-boom. The answer is B as in boy. A communication. A communication is defined as an advertisement. It's sent to, okay. A communication is defined as an ad if it's sent to 1, 2, 5, or 10. The answer is 2 or more. Once you send it to more than one person, it is considered an ad. And up to 10 people, you have to keep a record of who you send it to. Once it's over 10 people, you have to keep a record of what you sent. Good. An agent of a broker-dealer wants to engage in securities transactions outside of their firm. Which of the following applies? A, this is prohibited under all circumstances. By the way, I'm not saying it's always the right thing, but whenever I say prohibited under all circumstances, I kind of shy away from that. But anyway, A is not the answer. B, the agent may proceed without action. I'm not going to agree with that one. The agent must notify the broker-dealer. Maybe. D, the agent must obtain prior written permission for the broker-dealer. That's the answer. D, as in David, you need to open an account or do private securities transactions off the books and records of the firm. You have to get permission from the firm. If you want an outside job, you just have to notify and keep them abreast of it. I said breast. Okay. One featured offered by an annuity that is not offered with a fixed annuity. One feature offered by a variable annuity that is not offered with a fixed. Okay. I like this one. I like offered. Let's see. So they have a death benefit? Sure, they both do. If you die before annuitization. Guaranteed rate of return, that would be for the fixed, even though it's shitty. Tax-free growth of principal? No, because they're both tax deferred. So the answer has to be D as in David. If all else fails, you have to go with the one that that isn't wrong. Sub-account. If you see variable and you see sub-account or separate account, boom, that's the answer. Answer is D. A convertible bond is trading at $1,050 per share, which means either the price has gone up. I'm not going to go there. Okay. So the price is at $1,050 a share with a conversion ratio of 40. What is a parity price of the underlying stock? So first, you have to always do par. Par divided by the convertible price. You're going to do 1,000 divided by the good old 40. That gives you 25. So wait, where's the stock price? We don't know. They're asking stock price. So it's probably 42, but we're going to come back to it. So let's do 1,050 divided by 25. That gives us 42. See, here's a little way to look at it. So understand parity price will be somewhere around the ratio. Oh, look what I did. I am an idiot. I fucked it up. Good catch, Ken. Look what I did because I was talking about it. They gave me the price. You don't have to do the conversion. So, wow, you guys are screaming into the computer right now. But I caught myself, thank God. So I'm going to do 1,000. So they gave me the ratio already. I don't have to do it. So now we know it's A because it's the only one that works. But we're going to do 1,050 divided by 40. That gives me 26 and a quarter. There, good catch, guys. Thank you for stopping me from doing that. Okay. Because they gave me the ratio already. I jumped on the wrong one. So that's why speed kills. That's why you can go, oh my God, I passed. And then you go, how did I fail? Because you rush through these things. I rush it because I'm an anxious ADD bastard, but you don't do it. You need to take your time, slow it down, press pause, take your time. Even if this thing takes a couple hours. That's the thing. I don't want this to take a couple hours. I want this to take shorter, but you take a couple hours. You press pause, you watch it, you come back to it, stuff like that. Let's go, baby. Okay, here we go. A bond currently yields, and yet, just so you know, without the confusion, the answer is A as an apple because it's 1,050 divided by 40. So easy. That's where the stock should be trading compared to the bond. That's what parity means. Okay, a bond currently yields 8% maturity and pays a 6% coupon. What statement is true? So we got the triangle. Coupon's on here. The maturity's up here. The bond is trading at par. That's obviously not true because they're different yields. A bond at par, all yields are the same. B, the bond is trading at a premium. That is not true because the yield will be lower. The bond is traded discount. That's probably true because if you go by the triangle or the seesaw, whatever the fuck you want to use, if the coupon is lower than the yields, it is a discount bond. And the relationship between a coupon and a yield cannot be determined. No, that's not the answer. Okay. Okay. So the answer is C as in Charlie. It's a discount because the yield is higher than the coupon. Find that triangle, baby. Which of the following statements may be in an IA? Wait, slow down, Ken. Which of the following statements may an IAR properly make? The SEC has approved me. I am registered with the SEC. While the SEC doesn't say I'm qualified to manage investments, I must be since they approved me. No, and D, none of the above. The answer is actually none of the above because remember, it's an IAR. They're not registered with the SEC. If this said IA, we could probably say it's registered, but not in response to are you safe? It's a fact, but you can't use it to mislead. But anyway, IARs can't say it because they are not registered with the SEC. They register with the state. Okay. So the answer is D as in David. Oh, here's a good one. An investor purchases an asset for 200K and sells it 2 years later for 210 grand. Inflation averaged 2% annually. What is the investor's real rate of return? Remember, real rate of return is growth minus inflation. So let's do this. Let's do this. So we made 10 grand. Made 10 grand divided by our original of 200K. That's going to equal 5%. And then we subtract the 2 minus 2 equals 3. So our real rate of return is 3%. Answer C, baby. Oh, yes, C, baby. Okay. I'm going to get punch drunk by the end of this. How far along? Are we halfway yet? Let's find out. We're just almost halfway. Are we going to get done with this at all? Okay. I guess we're going to keep going. Investing in an S&P 500 index fund. If you see me looking tired because I have to go over to help my wife babysit, I may be coming on like 1 in the morning and I'll be dead tired, but I'm going to do it. Investing in an S&P 500 index fund that rebalances annually, because I promised I would, because I try to keep my promises, and I really want people to pass. Investing in an S&P 500 index fund that rebalances annually would be considered active, passive, top-down. Remember, rebalance. Always passive. So it's B. So it's B as in boy. A, no, because that's active. You're not rebalancing. Top down is looking at the economy, then the sector, then the industry, then the stock. Bottom up is look at the stock, then the industry, then the sector, then the economy. And dollar cost averaging is a passive thing because you're buying the same amount every time, but it's not rebalancing annually. It's going to be passive. Whenever you see rebalance, think passive. I guess unless they say rebalance daily, then that's just screwed up. Which of the following is an example of a place of business for an IAR under the USA? A, home office where the IR maintains records but never meets clients. A hotel lobby where the IR regularly meets with clients on a recurring basis. An office building where the firm maintains only administrative functions, and a virtual office address listed on the firm's website but does not use for meetings. So the answer is B because it's regularly meets. Anywhere you regularly meet is considered a place of business. Remember, they don't say office. And the other things, A, not meeting there, no clients. C, it's no clients. D, no clients. So the answer is B as in boy. Now, again, you could probably call the other ones, but we're trying to find the best answer. The answer is B. Which of the following securities trades at a price that may differ significantly from its NAV? A, open end? No, because it's always at NAV plus a sales charge. Close end funds? Yeah, that's the thing. That's an interesting question. We're going to come back to that. C, money market funds. And D, ETFs listed on major exchanges. That's a great question. So I'm really torn between B and D. So here's the deal. ETFs trade on exchange and they're pretty transparent. So a lot of people trade, they kind of arbitrage it where they're buying the securities and shorting the ETF. So usually, remember, they use the word significantly. ETFs, both B and D, ETFs and closed-end funds can move away from the NAV. But the closed-end fund is much more likely to move significantly away from it, above or below. ETFs always trade within a certain percentage of it because people will be trading it and shorting the ETF and buying the stock and then buying the stocks, then shorting the ETF. So it'll usually keep it within. So the answer is B as in boy. Okay, here's a great one. A meeting is scheduled with your client to discuss estate planning issues. She is married with one child, and you have committed to managing her assets in a way that avoids any estate tax. Whatever. However, portfolio gains increase the value of the family's estate 100 grand above the amount that would be subject to state estate taxes. In order to eliminate the immediate possibility of an estate tax, you recommend she utilize your $2 million you recommend she use her $2 million in unused lifetime gift tax exemption by A, gifting 100 grand to herself. You can't gift yourself. B, gifting 50 grand each to her child. No. C, gifting 50 grand each because that's yourself too. C, gifting it to nonprofits. And D, gifting each to her husband and a nonprofit. So here's the thing. I could almost justify D as in David because of the husband, right? But if you can give 50 to your husband, why wouldn't you just give 100? So the answer is C as in Charlie. Give it to the charities. You get the tax deduction and you get to reduce the gift. So it's a double whammy, I think. The answer is C as in Charlie. Which of the following best describes dollar cost averaging? A, investing more dollars when the market price declines? No, it's the same. Investing fewer dollars when the market charts? No, it's the same. Investing the same dollars amount at regular intervals. But remember, even though I think it's C, I will read the D. You always need the D. Remember that. Everyone needs a little D. Investing more dollars when the market price rises. So no, the answer is C as in Charlie. You invest the same dollar amount at regular intervals. So the answer is C as in Charlie. Okay. A client compares whole life to term. A distinct advantage of whole life is A, lower premiums, B, cash value accumulation to be borrowed against. I like that one. It's not lower premiums, definitely higher premiums. I'm doing that now. I'm switching some of my term into whole. I have a lot of whole and variable, not whole. I have a lot of variable and universal. I'm trying to switch more of the term into that. Lock it in. Lower premiums? No, because it's more expensive. B, maybe. C, coverage for a time period. That's term. D, flexibility. That would be universal. So the answer is B as in boy. Cash value accumulation that you can borrow against. It's an asset. Okay, so the answer is B as in boy. Whole life has cash value. Term doesn't. Term is like renting. A client is in a COLA. Their attorney calls the IAR and instructs them to liquidate their portfolio. The IAR should A, follow the instructions immediately. No. B, refuse until they see a written durable power of attorney. I like that one. C, takes instructions only from the spouse. What the fuck does that mean? And freeze the account until the client wakes up. Well, they may never. So the answer is B as in boy. You remember, durable power of attorney goes through death. No, scratch that. Durable power of attorney goes through incapacitation or coma. A lot of these tests love the comas. Okay, so here's the deal. So durable power of attorney will move through having a coma, incapacitation, stuff like that. Okay. So by the way, the answer is B. Which asset class is generally considered the best hedge against inflation? Long-term bonds, cash, commodities and real estate, preferred stock. Okay. Long-term bonds, no, they're horrible. Cash, no, it doesn't move. Preferred stock, no, it's a fixed income. It has to be C. Commodities and real estate, gold, silver, real estate, they move because prices go up. They move with inflation. We'll go to the Democrats attacking Trump now for the inflation because they said housing prices are up, commodities are up, whatever. They beat inflation. So the answer is C as in Charlie. If an IA wishes to withdraw their registration, which form must they file? So if they pull out, okay. Form ADVW. I'm going to do this. Okay, we did that. Okay, if an IA wishes to withdraw their registration, which form must they file? So Form ADVW, that sounds good. Okay. ADVW is advisor withdrawal. So A is the answer. Maybe, but we always check the rest. Form U4 is how IARs start. U5 is how they leave. And 13F is for large traders to file quarterly holdings reports. Okay. So the answer is A as an apple, ADVW. Okay, an investor buys a stock for 50, receives a $2 dividend and sells it for 54. What is the total return? Let's do it. So remember, total return is growth plus income divided by original. So we started at 50, or they might say ending value minus beginning value, right? So we go ending value 54 minus 50 equals 4, plus or minus a dividend. So that's 2. That equals 6. So let's do it. Then we divide by the original. So we're going to go 6. 6 divided by 50 is 12%. So the answer is C as in Charlie. I go growth plus income divided by original, but you can do the ending value minus the beginning value plus, that's 4, plus the dividend, plus any cash, that divided by the 50 equals 12%. The answer is C. Love it. How often must a mutual fund celebrate NAV? Celebrate? What the fuck am I doing? It's getting late. How much must a mutual fund calculate its NAV? A, monthly. B, weekly. A, at least once every business day. Real time throughout the day. So A, monthly, no, that would be horrible. It's B, weekly, no, that's horrible. Real time throughout the day, no. C is in Charlie. Every day they got to do it. They actually don't have a rule on when they have to do it, but they only do it once a day. So the answer is C is in Charlie. Okay. Make some room here. A 457 plan is a tax-deferred retirement plan primarily designed for A, employees of a small business, B, self-employed, C, state and local government employees, firefighters, shit like that, D, federal employers only. I would go with C as in Charlie. 457 is a non-qualified plan for firefighters and police. Remember, the big thing is it can either go in pre-tax or post-tax, depending how it is. But the thing is, you can take the money out under 59 and a half because they don't. The firemen and police department usually won't make it to 60. They want to let them retire earlier than that. I mean, I don't think you want a 59-year-old cop running around. Okay. Or firemen carrying people down at 60 years old. You'd have to carry them at some point. An IA acts as a principal in a trade with a client, selling securities from his own inventory. IA must A, obtain written consent from the client prior to completion of the transaction. B, only disclose it on the trading confirm. C, not charge a markup. B, be registered as a bank. I got to think about this. Let's think about this for a second. Do we need to disclose this shit? That is the question. Do we need to disclose it in writing, or do we have to, or are we going to just have to do it on the confirm? That's a great question. So where are we? So IA acts as a principal in a trade. And they're selling security own inventory, obtain written consent from the prior buyer, only disclose, not charge a markup, be registered as a bank. So we need written consent. Think about that. We can't tell them after. Now, agents don't have to tell them shit. But as an IAR, you have to tell them ahead of time so that they know, go, wait a second. You're telling me to buy, but you're selling it to me. You're the opposite side. You're not to let me know. And it has to be written prior. I'm not going to change it. I'm going to leave that. The dismiss works. Okay. A grandfather leaves his estate to his 3 children. How nice. Per capita. If one child dies before the grandfather leaving 2 young children, how is the estate divided? The 2 surviving children and the 2 grandchildren each get 25%. The 2 surviving children each get 50%. The 2 surviving children, they share 1/3 each, and the grandchildren share the deceased third. It all goes to the state. Now, I'm always screwed up on this because there's different levels of per capita. But the thing here is that the way it goes is that it's per stirpes mean by the branch. That means even if the kid dies, their branch gets the money. Okay. That's the way it goes. But what happens here is per capita, it's always going to be who's left alive. Now, there is a per capita per my descendants, and then it's actually some of the dead kids dead kids' children will get money, but they don't say that. So we assume that it's just whoever's alive. So it's going to be B as in boy, two surviving children get 50% B. Now, remember something. If it's per stirpes, basically, it would probably be C as the closest one. Okay. An investment advisor rep sends an email to a customer with the subject, please help my firm. The IR's email asks the customer to invite friends and family to a free investment seminar that's being hosted by the IAR's employer. Okay? Employee advisor. The IAR also asks the customer to pass on the IAR's email to others, which the customers did. This email is considered. What is this email considered? Okay? Now, it's considered advertising because it indirectly seeks business for the firm, is considered advertising and should be deleted immediately, should not have been sent and should be deleted immediately, which you're not supposed to do, seeks business for the firm but is not considered an advertisement. Since you're sending it out to invite people to a thing, it is considered advertisement because you're trying to find clients for the firm. So it's advertising. And you got to make sure it meets the advertising rules. You don't delete it right away. Okay. You don't delete it ever, really. Okay. When is an employee taxed on an incentive stock? Remember, this is qualified. ISO is qualified, not non-qualified. Non-qualified, you pay tax when you exercise, you pay tax when you sell, you pay tax all the time on ordinary income. When is an employee taxed on ISOs? A, when its option is received? No. B, when it's exercised? No. D, never an ISO is tax-free? No. C, when the stock is received to exercise, the option is sold. So when they sell the option after they exercise it, that's when they pay tax and hopefully it's capital gain. So again, the answer is C as in Charlie. Because NSOs, you pay tax when you exercise it, when you sell it, all that shit. ISOs, you want to pay tax when you sell it, and hopefully it's all capital gains. Which of the following is true about regarding equity index annuity? If option premiums are high, the participant rate on the annuity will be high. No, that doesn't make sense. If interest rates are low, the yield spread is low. That doesn't make sense. The losses are ignored due to the annual reset. I like that one. I don't love it, but I like it. And any gains credits to annuity are taxable on the current yield. No. So remember, they grow tax deferred. So D is out. A and B don't make sense. So I have to go with C. I don't love it, but it's the best answer because a lot of times equity in its annuities have a floor, which you can't lose money, or they have a reset, which it brings it back to where it was. So you can't lose money. And they have buffers and barriers. If it goes down too much, there might be a problem. But let's just go with that's the best answer. We don't do losses. An advisor recommends a stablecoin investment to a conservative 70-year-old retiree seeking income stability. What is a primary concern under suitability rules? Stablecoins may be suitable if they provide diversification. Okay, that's a true thing. Okay. Stablecoins are unregulated, speculative, and not FDIC insured. I kind of like that one. I'm leaning toward that one. Okay. They're likely unsuitable for conservative, especially at 70. The advisor must obtain written permission before recommending stablecoins. That's not a thing. Age alone disqualifies a client from cryptocurrency. No, that's not the only reason. So if they were 70 and a fucking baller, then they could do it. So the answer is B as in boy. They're unsuitable for conservative because there's a lot of risk to them. But they are legitimate. Remember something. They are a legitimate investment just for the right people. Okay. A client invests 10 grand in a bond fund with an NAV of $100. The fund distributes $2 dividends per share. What is your NAV after the fund? I think it's 98. I'm going to do the math here. Let me do the math. I mean, it should be. I mean, it shouldn't be that fucking hard, right? I want to make sure. So I'm thinking it's going to be 98 because remember I just say there's two things that affect an NAV. One is the assets going up and down, and when they make distributions. So the two things that because some people say it if they get a dividend, but the math shouldn't work, right? So a client invests 10 grand in a bond fund, they pay out a distribution. The two things that affect NAV are when the assets go up and down and when they pay out a distribution. So the answer is A 98. Okay. A client in the highest federal tax bracket is comparing a taxable yield of 6.3 to a muni bond. What is the tax equivalent yield needed for the muni bond to be competitive? So remember, we just do. This is not hard. Okay, it was not that bad. Why can't I get my calculator to work? So I'm going to do. So what's 100 minus? So 100, do it. 100 minus 36 is 64. That's some heavy ass fucking taxes, though, right? So that's 64%. That's rich person, right? So then we're going to multiply the corporate 6.3 times 0.64 equals 432. We're going to do it. So 6.64% times 6.3, which is the return, equals 4.032. So the answer is going to be A. Okay. So that's where we are with that. So that's the tax equivalent yield. If this was a muni, you would divide. So if this 6.3 was a muni, you would divide 6.3 divided by 0.64 gives you 9.8. So again, since it's a corporate, you multiply, muni, you divide. Remember, corporate, you multiply, muni, you divide. Okay, here we go. Which of the following can have shares that are priced above or below the NAV? We went through this already. Similar. The answer is closed-end fund. Because a closed-end fund can trade above or below the NAV. ETFs can too, but they're very close to the ETF. Okay. How far are we? We're getting there. Okay. I might finish the whole thing. Active market timing strategies are referred to as tactical, strategic, balanced, efficient. The answer is tactical. Tactical and active they're not exactly, no, they're fucking synonymous. As far as this test goes, they're the same damn thing. Okay. So it's A as an apple. An advisor recommends a DDM, dividend discount model, to value a company's stock. Which assumption is critical to this model? Remember, dividend discount model, they're not saying growth or anything. A, future earnings will grow at a predictable rate? No. B, future dividends will grow at a constant or predictable rate. It doesn't say growth model. If it's a dividend growth model, that would be that. Constant growth or variable growth. B's out. Stock price will equal book value? No. Dividend yield will always exceed bond yield. So we gotta figure this out. Okay. Now, that's interesting. I'm torn on this because right away I was saying I knew what it was. This is a hard fucking question. I got to see if I can do this here because I may be fucking this up. Maybe it could be. Okay. So I don't love it because usually it means the dividends are the same. But here's the thing you have to pick the best answer. I don't like any of them, right? So I'm going to go with this. D dividend yields, that doesn't work. So the thing is, the only one that works, I don't like it. I don't like it at all, but we have to go with it, right? So it's not that. It's not that. And it's not talking about earnings. So it's talking about future dividends. So it has to be B. Again, you have to remember dividend discount model, that would normally be constant growth, but whatever it is. But again, sometimes you got to find the best answer in a shitty bunch of answers. So that's the answer. It has to be B because you have to have a stable growth. You have to have a stable understanding of what it's going to be. So the answer is B as in boy. Again, you got to fight through it. A client places an order to sell 100 shares of ABC at the market. The spread is 50-10 bid by 50-20 ask. Remember, at what price will the customer limit order be executed? Okay. First of all, it's a market order. So let's change that to market order. Just change it to order. Okay. So you're going to sell at the bid. You buy at the ask, sell at the bid. The answer has to be A. Sell at the bid, buy at the ask. It has to be A. Now, in real world, it'd probably be D, but in the test, it's 50-10. You hit bids. Hit bids, take offers. Okay. A tenants in common account has two owners, each with 50% interest. If one owner dies, what happens to that share? Okay. A, passes automatically to the survivor. No, that would be right to survivorship. B, passes the deceased owner's heirs, estate, beneficiaries. That's probably the answer. C is forfeited to the brokerage firm. They wish. D, passes surviving owner's spouse. No. The answer is B as in boy, goes to the owner's heirs, estates, crap like that. Okay, back to an analyst wants to measure a company's ability to meet its short-term obligations using its most liquid assets, excluding inventory. Oh, I'm not giving that to you guys. Yeah, whatever. We have it already. Which ratio should they use? I should have taken that out. I don't like it. Now, A, current ratio, B, debt to equity, C, quick, D, price. You got to get this. It's probably easy. Since we take out the inventory, it's quick ratio asset test. Remember, the quick ratio of the asset test is current assets minus inventory. When I do this with my students, I'm going to take this out. So I'm going to delete this now so I don't. Oh, maybe I should leave it because maybe it'll be confusing. So leave it in there for now. Okay, onward. The answer is C as in Charlie. Okay, an investor puts 10 grand into an account earning 5% annually. What is the approximate value of the account after dose years? Okay. There's another math question farther down, and I want to make sure that I'm fresh. I probably have to do that in the morning. So let's do this. So we have 10 grand and we're earning 5% a year. So we're going to do times 1.05, 1.05, which I think it's 10,500, but let's double check. 10, I don't like, remember, don't do math in your head, times 1.05 equals 10,500. So then we know that A can't be it, right? Because that's we have one more year. Times 1.05 equals 11,025. So we do 10.5 times 1.05 equals 1125. Now, not everyone likes doing that. So you technically could do this. You could do, because they don't get it, and it's fine, 10 grand times 5%, add it, then take the number and do 10 grand times 5% and then add it again. It's an extra step. The 1 point does the add in part. But again, totally fine. 10 grand times 5%, get my new number, take that new number times 5%, add it, and then you're done. It'll work just the same. I'm just lazy. According to CAPM, risk premium is defined as, according to CAPM, risk premium is defined as beta multiplied by the risk-free rate. No. Sounds good, but it's not. Expected return minus the risk-free rate. Mm-hmm. Standard deviation of the portfolio. Alpha generated manager. Look, it has to be this one. So risk premium is the amount you're earning over the risk-free rate of return. So again, risk premium is the amount you're earning or expected to earn over the risk-free rate. And when they do standard deviation, it's this divided by, no, sorry, when they do Sharpe ratio, it's this over standard deviation. See what happens? I roll into, it's my dementia. So ADD. So expected return minus the risk-free rate over standard deviation is the Sharpe ratio. I think my mouth goes way too fast. That's why I get in trouble, because my mouth, even in high school and college, my mouth went way too fast for my brain. But I learned to fight because I was got my ass kicked so many times. Okay. The issuer of a 10-year 8% bond, currently selling at 935, has a right to call a bond in 5 years with a penalty of 50. Which of the following statements is true? Okay. So this is a discount bond. Triangle time, baby. Here we go. Yield to call is lower than the call to maturity. No, because a discount, yield to call is higher. A's out. Boom, A's out. I'm going to throw that up. A's out. Then yield to maturity is lower. No, because that would be current yield to maturity. So that's out. Discount. Okay, so now we're down between C and D. Now, D is stupid. In 5 years, pay 950. No, they'd have to pay more than 1,000 to get it. They'd have to pay 1,050. So D's out. So yield, remember, whenever you calculate a yield, you're assuming that thing happened. If you calculate yield to call, you're assuming it's being called on the first call date. If you're doing yield to maturity, you're assuming it's being called, it's going to last to maturity. Also, remember, whenever you're calculating a yield, you're assuming reinvestment at that yield you're trying to calculate. You have to do it that way. According to the NASAA model rule on FIR reporting, financial reporting requirements for investment advisors, how many days do investment advisors have to file the financial statements with the state administrator following the end of the investment advisor's fiscal year? A 30, B 60, C 90, D 120. Remember, always remember, end of the year shit is 90 to the regulator, 120 to the customer. 90 to the regulator, 120 to the customer. I'll say that again. 90 to the regulator, 120 to the customer. Okay, so the answer is 90, because you send it to a regulator. Okay. Oh, that's, I was thinking we were close, but I realized everything's stacked on top of each other. Okay. Which of the following characteristics is true for a non-qualified deferred comp plan? We'll start with A. Plan assets are subject to claims of creditors. That's kind of true. B. Plan must be offered to everyone. No, because it's non-qualified. Out. B is out. Participants may elect to do so only up to a legal limit. And there is, but that's not the answer. D. These plans are designed to benefit employees who are not highly compensated. So the answer is A is an apple. If you have a non-qualified plan and it's held by the company, not by someone else, then if they get sued, they can go after those assets. So the answer is A is an apple. Okay. Under the Uniform Securities Act, a non-issuer transaction includes, this is a great one, non-issuer transaction includes the sale of securities in A, mutual fund from its investment portfolio. We'll come back. B, company IPO. That's obviously an issuer transaction, so that's out. C, oil and gas limited partnership. Maybe. We'll come back to that. I'll explain why that's different. D, a company ESOP. Basically, they're selling shares to the employees. So B and D are definitely IPOs or selling primary offering. Now, that means they're issuer transaction. If it said a mining lease, C would be the answer. They'd get you with that one. The answer is A is an Apple mutual fund from its portfolio. Because remember, normally when you buy shares of a mutual fund, you're buying it for the fund or sponsor. So it is a primary offering or an issuer transaction. But it's not saying that. It's saying the mutual fund selling the shares in the fund, buying the IBM, selling the Tesla. All that's at trading. That's not issuer shit. So the answer is A is an Apple. Nope. Nope. I think we're doing the tips. There we go. Okay, I'll end on this and we'll come back later. So I might be just different. I might see something else. Okay, now, inflation protected treasury notes are issued with $1,000 par value and a 5% interest rate at the beginning of year one. Inflation during the year is 3%. Which of the following statements are true? So remember, tips we adjust for inflation, okay? We adjust for inflation. So what we're going to do here is adjust for inflation. Our during the year is 1, so our inflation is 3%. We're going to increase our par value by inflation. So we're going to do 1,000 plus 3%. That gives us 1,030, okay? That gives us 1,030, okay? Now, then we just do 5% of that. 1,030 times 0.05 is 5,150. Now, if they say what is each payment going to be, then you do half of that. But it's not 1,050 par value because it goes up by the inflation. So if inflation was 7%, it'd be 1,070. And then you just do the coupon based on that. Okay. Under the NASAA model rule on unethical business practices of IAs, investment advisor reps, and federal covered advisors, the determination of whether an investment advisor traded excessively in a client's account would be viewed in relation to all of following except A, financial resources, B, investment objectives, C, character of the account, which is what it's like. Are they aggressive, small, big, whatever, and D, gain or loss. So the one thing we do not care about with churning is whether they made money or not, okay? So the answer is D as in David. It does not matter if they made money or not. Gain or loss is not part of it. That's the answer is D as in David. Okay. In order to generate more business, an investment advisor, rep, a state registered advisor hires a solicitor to find new clients. The IAR will pay the solicitor a percentage of all advisory fees generated from the new client accounts. Under the USA, all the following statements are true except the IAR must have a written agreement between the solicitor and advisory firm outlining the solicitor's duties. That sounds good. The solicitor must provide a copy of the advisory form ADV as well as a disclosure doc for all depressed employees. I like that one too. C, the solicitor must have client sign an advisory contract at the same time the Form ADV and disclosure document are delivered. We'll come back to that. D, the solicitor must be registered as an IR to receive advisory fees. A, B, and D sound good. C is not the answer. They don't have to sign it right at the same time. They could sign it a week later, 2 days later, whatever it is. They do not have to sign it the same day. That's why C is the answer. Okay. A client's portfolio consists of 6% corporate bond, which was purchased for $11,000. It's funny, I have that written twice. Hold on. Yeah, we don't need that. And a non-interest bearing money market fund. Okay. The bond is currently trading at par. What is a client's current yield? Well, bonds at par. A bond at par, all yields are the same. So again, I'll say this. I own a 6% bond purchased for 11 grand, and the bond is currently trading at par. What is the current yield? It's going to be par divided by, it's coupon divided by par, the market price. The market price is par. So remember, a bond at par, all yields are the same. So the answer has to be 6% because that's the coupon and it's trading at par. Under the USA, which of the following statements is true regarding agent registrations? Renewal dates may be determined by the administrator. No fucking way. B, once issued, all registrations made effective until they are withdrawn. No, I wish. C, registrations expire 1 year after the effective date, regardless of the date. That sounds like a security. D, all registrations expire annually on December 31st. That is the answer. D is the David. Agents, IARs, all of state IAs, broker-dealers, all end on December 31st. A whole life insurance policy includes which of the following? A death benefit for a specific amount of time. That sounds like term. B, a sub-account investment portfolio. That sounds like variable. C, a guaranteed debt benefit for life. I like that. D, a variable interest rate. No, the answer is C as in Charlie. You are getting paid. You are getting, when you die, your family will get a check. Okay. Which of the following would be a permitted use of soft dollar compensation? Office rent, travel expense to a conference, research reports and market data software, furnitures and computers and hardware. No, the answer is C as in Charlie. The safe harbor, which means you're safe, that if you do these things, you can do other things, but these are safe. You can do it for tickets, getting into a conference, research, and I'm getting old. Research, software, seminars. That's what it is. Those are the three safe things. So the answer is C as in Charlie, research reports and market data software. Under modern SEC marketing rules, an investment advisor may use testimonials if, remember, this is SEC, not state. If it's state, the answer is never. A, they're never paid for. No. B, they clearly disclose if the bond is a client, if they were compensated in any conflicts. That sounds really good. Literally, they say everything. They're only from celebrities. No. They're strictly prohibited. No. So the answer is B as in boy. SEC marketing rules, and if the states, remember, always keep in mind, NASA says it's no, but if a state adopted the SEC marketing rules, then they can do it. So they have to clearly disclose if the person is a client, if they're compensated, and any conflicts of interest, and if you paid them. Good, what you just said. Good. So the answer is B as in boy. How often must an access person file a transaction report regarding the personal securities trade? Monthly, quarterly, annually, weekly? It's quarterly. You have to do a quarterly transaction report and then an annual personal securities holdings report. And they might ask you the days, go look them up. Not a lot, but they might. Okay, we are stopping here. I'll come back later.
If this speech stirs your heart, show your allegiance, like the video, subscribe to the cause, and together we shall conquer the future.
Okay, it's a new day, baby. It's a new day. Maria's father purchased shares of an actively managed mutual fund many, many years ago, many, many moons ago, and consistently reinvested all dividends. He never sold any shares during his lifetime. When he passes away, Maria inherits the account and later decides to sell some of the mutual fund shares. For purposes of calculating her capital gain or loss on the sale, what is Maria's cost basis in the inherited mutual fund shares? So this is a long one. This is long. I would make sure I read all four before I do anything. So the total amount her father originally invested, including all reinvested dividends. Let me make sure my mic's high enough. Sometimes it goes down. Okay, it's good. It's good. Although sometimes lower is better with my voice. The total amount her father originally invested, including all reinvested dividends over the years. B, the fair market value, NAV, of the mutual fund shares on the date of her father's death, or alternate valuation date if properly elected. 0, because inherited assets do not receive a cost basis. D, average of all historical prices her father paid for the mutual fund shares. So the answer is B, because remember, when somebody dies, they step up the cost basis. Remember that. When somebody dies, they step up the cost basis. Good. Okay, to achieve, this is one I have an issue with, but I get it. To achieve maximum diversification benefits, an investor should add an asset as a correlation of, okay, so it's -1. Here's the thing, to be truly diversified and have on non-correlated assets, so the diversified is 0, but they're asking for maximum diversification. And on this test, they're going to say -1 every time. I 100% disagree with that because I get it, because the problem is, if you have a thing that goes up 10% and down 10%, you can't make money. So this is not about making money. This is about spreading it, getting rid of the risk. So this is going to be -1, even though in real world, it's closer to 0. Okay, we're good. A young couple with a limited budget needs substantial death benefit protection for the next 20 years. Triggers. While their children are young. How sweet. The most suitable recommendation is A, whole life, B, variable, C, term, D, universal. Look, this trigger words, limited budget, 20 years. It's got to be term, because whole life, variable, and universal are more expensive than term, and they say for 20 years, and they say limited budget. So it's always going to be term, because term is like renting insurance. It's cheaper. Whole, variable, and universal, like buying insurance, is more expensive, but you get equity.
Friends, fellow Americans, and all who ride with me, if these words move your spirit, let it be known. Press the like for liberty. Subscribe to the cause. Together.
An advisor's succession plan addresses which of the following situations? A cyber attack, disabling. Remember, press pause now because I'm gonna answer it as I go, because who needs to listen to my fucking voice a million times? A cyber attack disabling the advisor's electronic communications? No. A natural disaster cutting off access to physical location? Boom, no. A problem with the advisor's computer systems? No. The retirement of an IAR who maintains discretion over manage. So succession plan is like the movie Succession. Who's going to take over when you're done? So it's always about when the person retires, what's going to happen. And remember, an IAR, this could be on the test, can have, as long as they signed a written agreement before they retire, not resign, not move to another place, retire out of the business, they can actually get ongoing commissions on their existing clients until they die or whatever they do. A lot of places just buy you out for like 5 years or whatever, but you can arrange it where you get paid till you die. But no new business. Like if you get a husband and wife and then you retire and then they get their kid, the kid's not yours. The husband and wife still your shit, but the kid is the new firm's. Okay. According to the USA, an IA may only use oral discretionary authority if it receives written authorization within 10 days. That sounds awesome. If it only uses oral discretion once per year, that makes 0 sense. Under no circumstances, that's agents, that would be true, but IAs, no. And if it has permission from the administrator, no. I'm going to go with A. Boom. So they're allowed to do it. You have oral for 10 days of oral. No, 10 days of verbal. And then after the 10 days, you have to get it in writing or it ends then. Compared to a C Corp, what's a disadvantage of a limited liability corporation? Limited ability to raise capital, ease of formation, that's actually a thing. It is easier than a C Corp. Limited liability for owners, that's for both. And flexibility management structure, no. So the answer, the disadvantage is limited ability to raise capital because C Corp is the best rated. West will lose a ton of money. Good. So A is an apple. What ERISA rule requires a qualified plan to offer at least 3 different investment options with different risk levels? Okay, so what they're saying here, okay, what we're doing here is this is saying what I'm going to say, what rule. Remember, it's not what plan, it's what rule. And it's 404C, okay? 401k is a retirement plan. 403B is a retirement plan. 457 is a retirement plan. 404C is a rule about you have to give diversification. You have to give ability to change at least quarterly, and you have to give them education. If you do that, then you can't sue the sponsor if you have a bad year because they're giving you enough rope to hang yourself. What's the benefit of buying shares of an open-end investment company? The fund has a diversified portfolio. I like that. Low expense ratio. No mutual funds have high expense ratios. The manager living in rich areas. That has nothing to do with it, but they buy and sell all day long and they get paid. It's a lot. C, low turnover. No, they're probably usually pretty active unless it says ETF. And shares trade and exchange. No, that's a closed end or an ETF. So the answer is a diversified. Now remember, if it's called a diversified fund, it has to follow the 75-5-10 rule. 75% invested, no more than 5% of the fund's assets in any one security. And D, you can own more than 10% of the voting stock of any one security to be called a diversified fund. But pretty much mutual funds are considered diversified. That's one of the reasons you buy them. The other reason is liquidity, because you get to sell at the NAV any day, and professional management, which I think is overrated. Which of the following statements is, again, the answer is A is an apple. Which of the following statements is true about futures contracts? Some contracts settle by delivery of the commodity, while others settle on cash. They have a premium. No. Contracts give the buyer the option to take delivery. The contracts give the option to make delivery. Future, remember, unlike options where you have the option, if you buy an option, you have the right to buy or sell. If you right to exercise or not, okay. You don't, at both sides of the futures contract are obligated. So the answer is A, because some do deliver the commodity, some do, it's like index options, index futures settle on cash. Sometimes you do commodity. So the answer is A as an apple because they don't have a premium. You're buying it. You're signing a contract. Okay. And there's no options on this. So the answer is A as an apple. An IA, we're getting close. The IA that maintains discretionary authority over client accounts is reviewing its BCP, business continuity plan, which is the following required under federal regulations. Let's see. Annual notice of the BC to all clients, a written succession plan that addresses access to client assets in case of the advisor's death, quarterly testing of backup systems, and documentation that complies with gram leaching. So now, I'm torn on this because I know you have to do testing, but I don't think it's quarterly. I think it's annual system. So let me double check to make sure I don't give you a bad answer. I think it's A, but let's see where we come out with it. I'll be right back. You won't even notice. It'll be like, snap back. The answer is actually B as in boy. So there's no requirement. Broker dealers have an annual notice. IAs just have to have it on the website. So the answer is B. They have to have a succession plan go in there. That's, if you want to look it up, it's compile rule 206 parentheses 4. Okay. And D is for Reg SP, and there's no quarterly testing rules. Okay. So the answer is B as in boy. Ken was wrong, but he can admit it. But I'm going to deny it. An investment company is reviewing its marketing materials, which of the following practice is prohibited without appropriate disclosure. Comparing the fund's performance to a broad-based index, including testimonials without disclosing that the client was paid for the endorsement. C, stating the advice is personal, it applies to all funds in a strategy, and both B and C. That's very interesting. I never like a double question. I never really do. I just hate them. So we know that B is wrong because you can't do that shit. And then if you do general stuff, you can't say this personalized because it's not. So the answer has to be D, both B and C. I don't like the multiple answers on the questions, but it is what it is. Which of the following is indicated by a debt to equity ratio of 1? A company with a balanced and acceptable financial situation, a company with the ability to pay off its debt, the market value of a company's debt is equal to the market value of a company's equity, and an equal amount of debt and equity is reported in the company's financial statement. So so here's the deal. So I am okay. Let's see, let me fix this a little bit. You're my guinea pigs, right? A and B are out. That's not a thing. So I'm going to go with D because it's not the market. If I borrow money from you, it doesn't matter if the interest rates go up or down. What I owe is what I owe. So it's got to be D, as in David, because it's the amount, not the market value. If providing investment advice is a primary business of an IA, all of the advisors, directors, officers, and partners are presumed to be. So it's specifically in the rules. This is like I read this, okay? It says if the providing investment advice is primary reason, all of them are access people. Okay, they're access people, not supervised. They're all supervised anyway, probably, but that's not the rule here. The rule is if your primary business is advice, all of the advisors, directors, officers, and partners are presumed to be access people. So the answer is A, which means they have to do an annual securities holdings period, annual securities holdings report, and a quarterly transaction report. A brother and a sister want to open a joint account as tenants in common. Which of the following statements is true about this type of account? A, the assets will pass to the surviving owner. B, the assets will pass to an owner's separate estate upon death. Tenants in common, remember. C, the type of account is only permitted for married. D, this type of account is avoid probate. The answer is B as in boy, because if it's tenants in common, it goes down to your heirs, your beneficiaries, your estate, your own shit, not the other person. Rights of survivorship goes to the other person. Which of the following describes the primary difference between a fund of funds and a traditional mutual fund? Okay, fund of funds only invested in bonds. No, that doesn't make no sense. Okay. Investors pay 2 layers of fees with fund of funds. I like that because remember, a fund of fund is a fund, mutual fund, or a hedge fund that invests in hedge funds or other funds. Fund of funds have higher liquidity. That is not true. Traditional mutual funds require higher investors. No. So the answer is B as in boy because remember, it's a fund of funds. It's a fund owning other funds. Okay. Now, in real world, it's usually a hedge fund that owns other hedge funds, but it can be a mutual fund that owns hedge funds. It's more for sophisticated, but you don't have to be accredited. But you are paying the hedge fund fees and the mutual fund or hedge double fees. So the answer is C, B as in boy. Okay. If an investor expects a market-wide decline, what's the most suitable recommendation? So we're bearish. We got to do the bearish thing. So short of put is bullish. Long a call is short of put is bullish. Long a call is bullish. Long index futures is bullish. 3 bulls and a bear, take the bear every time. Remember, think of futures as calls. I mean, they're not, but think of the direction. Long futures is bullish. Short futures is bearish. So we're going to be as in boy. We're going to sell them. How must an investment advisor disclose the use of social media to customers? A, Form 10K. No, that's the annual report for issuers. Form 8K. No, that's a special announcement for issuers. C, Form 10Q. That's a quarterly report for issuers. Form ADV. ADV is how advisors disclose shit. Bundaba. We're getting close. 3 pages away. An individual holds a long position in XYZ, trading at $50. To protect against downside risk, which strategy is most appropriate? A, buy a call. No. So remember, we're bullish since we're on. We have to do bearish things. Buy a call, that's bullish. No. B, sell a put. No, that's bullish. C, buy a put, that's bearish. D, sell a call, that's bearish. So we got 2. It's between C and D. Remember, you always got to knock shit out. Now remember, hedge is buy. You buy to hedge, you sell for income. So buy for protection, you sell for income. Remember, we buy insurance, we don't sell it. So the answer has to be buy a put. If they say hedge, insurance, protection, it's buy a put. If they say income, add yield, add increase yield, that's going to be a solid call. The answer is C, buy a put. Under the USA, which statement regarding IA contract assignments is correct? A, partnerships, I'm going to just answer it. Partnerships, because I have a class starting in 5 minutes. A, partnerships may change all partners without notifying clients. No, that's not true. C, partnerships must obtain client consent if a majority of partners leave. I like that one. Corporations may transfer controlling interests without client notification. No, you got to always let them know. And all clients must approve any change in advisor. No, that's not true. So the answer is B as in boy. If your ownership changes, you have to let the client know. Okay. If majority changes, you have to get permission. Okay. Which of the following is not suitable to be held inside a traditional IRA? Which of the following is not suitable to be held inside a traditional A, growth stocks. No, that's fine. B, muni bonds. Oh, I hate those. Remember, because they're tax free. C, T bills. No, that's okay. Boring, but okay. And international equity, that's fine. So the answer is B as in boy. Now, you can tactically put them in there, but don't. It's just stupid. There's not a regulatory reason. It's just you can't do that shit. So the answer is B as in boy. No munis. And you can even put annuities in an IRA, but there's no extra benefits. Which market index is best described as price weighted? Okay, most indexes are market cap weighted. Like the bigger it is, the more weight it has, right? But the only one that doesn't is the Dow Jones. I love the Dow, but it is price weighted, which what that means is that a stock with a higher price, okay, price weighted means a stock with a higher price will move the stock more than a price with a stock with a lower price, which doesn't make sense because if you don't do a split, you're going to move it. Like if you have a stock trading at 1,200, it's going to move the Dow more than one at 300, even if the one at 300 isn't actually a bigger company. So again, Dow Jones is price weighted. Everything else is market cap weighted, size of the company weighted. Here we go. Debentures. Hi, I need a debenture. Are best described as, remember, debentures are unsecured corporate bonds. Answer is B. Secured bonds, no. B, unsecured. I want to read them all anyway. C, hybrid, no. That's like this. It sounds like a convertible. And D, government issued debt. No, that's a treasury bill, no bond, stuff like that. So the answer is B as in boy. Debentures are unsecured corporate bonds. Okay, we should be able to see this. Okay. We're going to do this. Okay. So a client invests 10 grand today and expects to receive 15 grand in 5 years. Using the present value concept, what is the implied discount rate? So you can't really use a rule of 72 here because I'm going to change this after this to do a rule of 72 once you can see it. But this is more kind of just ballpark it. This is hard work. So I'm going to do this. I know that since it's no double, it's a half. I could probably screw around with that, but that's too high math. I'm going to actually do the reverse engineering. I'm going to look at the 4 choices and look, 21% doesn't work. I'm going to throw that out. It's an outlier. So I'm going to take I look at the 3 choices. I take the middle one. I'm going to work on that. The way I do it is if this works out to be too high, then it's going to have to be 8.5. If the number is too low, it's 10. So all you have to do is 1. Now, let's do the math here. So I'm going to do 10,000 times 1.097. This is the future value thing, right? So we have to figure this out. So let's do this. We're going to do 10 grand times 1.097. And we're going to do that 5 times, which is a pain in the ass. But this is why maybe one of these, this is what you do at the end. You kind of save it for the end. 10 grand times 1.097. That equals 10,097. It's kind of makes sense. 10,970. Then we're going to do that times 1.097 times 1.097 equals 12,034 times 1.097. And you see that I'm just putting 1 in front of the 9.7 times 1.097. That's 13,201 times 1.097. Yes, it's a pain in the ass. Times 1.097. Then it goes 14,481. So that's the 4th here. 14,481. We do last one times 1.097 times 1.097. That equals 15,886. That is too high because it's higher than that. Since it's too high, it has to be a lower return, which means it has to be 8.5. If this 15 grand came in lower than 15 grand, I would have to pay 10%. If it came in at exactly 15 grand, I do 9.7. Now you can do this. I'm not going to do it because I already got the right answer. You can do this if you want to double check. Just do that. and go all the way through and and I get you, you'll come up with like 14,999 or 15,001, but it'll be the 15 grand. That's how you just do the reverse engineer one. Now I'm going to show you, let's say it's a little different. Let's say instead of 15 grand, it went to, I'll change everything up. Oh, I got to change it in here, right? Okay. Let's change it to 40 grand. And we'll make it 20 years. So with 10 grand today, expect to receive 40 in 20 years. So I'm going to do the rule. Whenever I see this, I try to do the rule of 72 first. So did it double? Yes. 10 to 20 is one double. 20 to 40 is two. So it doubled 2 times in 20 years. So I'm going to write that down. Doubled 2 times in 20 years. So that means it doubled twice in 20 years, which means it doubled 20 divided by 2 is going to be 10 years. So it's going to double every 10 years. And the rule of 72 is always going to be 72 divided by the number of years. That's 10 equals 7.2. So again, this is not the same thing, but 7.2%. So I'll make sure we got this. It doubled twice, 10 to 20, then 20 to 40. Now, that's 2 doubles. 20 divided by 2 is 10 years. That means that's how often it doubles every 10 years. Then you just do 72 divided by the number of years. That's the rate of return. That's your internal rate of return. That is it. Guys, thank you very much. Don't forget to check me out every Thursday night where we go over the 65 and the 66. Don't forget to subscribe, like, and share, and all that other good crap. And I will see you on the other side. But remember, you always want to remember to take this test like a savage.